Good afternoon, it's Christian Thwaites from Brown Janikowski, Friday, October the 28th. This will be going out on Monday, October 31st. Happy Halloween. A fairly quiet week in the markets last week. Earnings, we're still powering through earnings. We're about halfway through that. So big numbers came out of companies like Amazon, Google, and Apple, all of which moved the market. And this coming week, we've also got big earnings coming out of the major oil companies, which we're watching very closely because those have a big rebound effect. Remember, oil has been a very weak sector for about the last year and a half, so expect some upturns there. Markets have been trading pretty flat on equities. I think people are just waiting for this earnings season to come through, still consolidating the run-up that we saw in the second quarter. So stocks have been good and holding their patterns, which we're pleased about. But there has been some movement in US Treasuries and some other major sovereign bond funds. And if you read about it in the blog that's going out today as well, you'll see that we highlight that. But I want to show you just quickly the relationship between stocks and bonds, because it's more complicated than has been assumed, and it's changed. Take a look at this graph, and you just go right to the top right-hand corner. And what we've matched here is the MSCI World Index. So that's every equity market in the world all put together, and then the US Treasury as a proxy for bonds. And you can see that pretty much since 2014, the same amount of money, you'd made the same amount of money whether you're in stocks or bonds. They pretty much rose together in unison. Before that, of course, we saw this big run-up in bonds coming out of the financial crisis. They tended to outperform stocks, and then there was a little bit of stock outperformance. But the ones I want to draw your attention to are the two big bubbles over here, where we saw rates increasing. So rates increasing in both cases, that's why the bonds went down, and stocks going up. Not just up, but up very sharply. And the point about this is that if we do get a correction in the bond market, it doesn't mean, and it could well actually mean, it doesn't mean a negative stock market, it could well mean a very strong stock market. And we think if rates are going up for good reasons, strong economy, benign inflation, and a general feeling that the market is expanding and labor is reaching fuller employment, those are good indications for the market, and we could see some very strong outperformance of stocks over bonds. So remember, this relationship back here was very, very strong. It's been different recently. It could well go the other way. Thank you very much.